Welcome to the Money Show, the only daily show of its kind which brings the market's top financial experts to answer all of your financial queries. I'm Avni Raja. First up, let's see what's making the headlines. Markets end flat after swinging between gains and losses. IT and metals lead gains while realty and pharma post losses. Small caps slip into the red. Bharat 22 ETF may soon be going global. ET now learns the government may be looking to list the fund overseas in a bid to diversify investors and raise more funds. US and London stock exchanges being considered among others. That's an ET Now exclusive. Unified Payments Interface or UPI clocked 105 million transactions in November 2017, which is the highest ever. NPCI data also shows that the value of transactions rose by about 37% to 9,680 odd crores in November versus about 7,050 crores in October. All right, now joining us on the show today is Uday Dhoot, founder of oipesa.com. Thank you very much, Uday, for joining in. Great to have you on the show. We've got a lot of questions coming in from all our viewers for you. But before we get into those questions, I want to talk to you about the importance of having really an investing checklist, because, you know, these days with the kind of marketing that financial products are seeing, on top of that, you have, of course, the usual human emotional bias at times which tends to come in. How does one really go about sifting through and ensuring a balance and making sure that you're investing right and the way you actually need? For that, how important is having a checklist, and what kind of an investment checklist should one actually have?
So, like you said, I think it's very pertinent to the market that we are in, as people have rightly said, success is a lousy teacher, right? Because what happens is when you have been successful in investing, you end up thinking that all your decision-making frameworks are right and how you are taking decisions is the best way to take decisions. Then you start betting higher on things and until the risk sort of shows up. And like we all know, in markets, in cycles, risk always shows up some point in time or the other when you least expect it to show up. So many we would say renowned investors and people who have done really well over multiple cycles say they do have some kind of mental models or checklists that one can have. And when we say a checklist, one does not want to necessarily describe a process of doing something, but these are quick reminders for you to sort of make sure that you are guided in the right direction. The other thing that you pointed out are human biases and emotions, right? So I think money is one of the most emotional subjects which is around, and it brings in all types of emotions. Money brings in the emotion of greed, it brings in the emotion of fear, and because of which our decision at times can be clouded, can be sort of irrational, because we are not thinking clearly, we are thinking from our emotions, which is why a checklist can be a great way to sort of look at your investments. Now, how do you go about making these checklists? What kind of checklist you should have? I think this is something that everyone has to explore his own path of investing. But I thought that given today where we are in terms of markets having done extremely well over the last 1.5, 2 years, and we see all these IPOs coming in and everything getting subscribed very quickly, and basically a lot of money is going into equities, and there would be a lot of people who are going into equities for the first time. I thought it would be nice to think about, say, what if we had a checklist for the bull market, and sort of keep looking at it and asking ourselves more than checklist, a set of questions of what we should be doing. So my first question, and we keep sort of pointing this to individual investors and families, is that asset allocation is a very important decision. Now what happens when the markets are going up is that let's say if you have a mix of equity and fixed income, obviously equity is going up much faster than your fixed income portfolio. So your portfolio will start moving more and more towards equity, and obviously you will possibly at some point in time move away from your right allocation between equity and fixed income into possibly more equities. Now it is a time to make sure that you are constantly, at least once in a quarter, checking where your asset allocation is. Are you in the right band that is right for you, and making sure that, hey, yes, I am in the right band of asset allocation. So just keep asking that question, keep checking that every once in a quarter to make sure that you're not tilting away into much higher risk portfolios. The other thing that possibly we need to check is that during times of when markets are up, we end up being fairly confident of many things. We are confident of getting better bonuses, we are confident of getting better returns from our investments, and that overall bullishness basically pushes us to commit a lot of money to illiquid investments. Now this is very, very important, saying that check whether you have enough liquidity to last you if there was a downturn in next 18 to 12 months. We have seen this when people have heavily skewed their portfolios towards real estate, and then suddenly the real estate market has dried up, that you do not have enough liquidity to sort of sustain. You are asset rich, but you are cash flow poor. So just make sure that you're asking your questions, saying that, hey, do I have enough liquidity? The third thing that I would like to ask people, and when they're making these investments, is that as you keep looking at people making those IPO investments at times on very pricey stocks which still gets listed up at a higher valuation, and you say that, hey, this is very easy way of making money, and what happens is that during bull markets we sort of all start collecting such type of junk investments in our portfolio, things which we have heard from friends saying that, no, you buy this, it will do well in the next 3 months, 6 months or 1 year, and we end up picking up such stuff. I think what is important for us to ask ourselves really is that which part of our portfolio is the long-term portfolio and which part of our portfolio is purely speculative. You should rein in your speculative portfolio to a very, very small percentage of your total portfolio. Whenever you see your speculative portfolio going beyond that total portfolio, I think it is important to just ruthlessly cut down on your speculative portfolio. And the other way to check on this is that, let's say if you have a bunch of investments and imagine that those investments have gone down by 20% in the next 1 week, 2 weeks or whatever time frame, and you see, would you still be holding on to those investments? Would you still keep those investments with you? This is a good way to see whether you really believe in those investments. If you're not going to hold them then don't hold them now, and possibly get into investments that you really believe in, that you think they can stick with in the long run, whether the markets go up or down. I think these are 4 or 5 pointers that we can think of right now. As investors progress, this is something that you have to continuously evolve and build something that works for you as an individual, as a family.
Extremely crucial points, Uday, that you mentioned there for investors. Very important to have that checklist to ensure that you don't get caught up, whether it's human emotions, whether it's the kind of marketing across financial products, and you only invest where you really need and in investments that you actually believe in. Uday, let's get to our first question then, coming in from Ravi Teja, who sends an email to us. He says, can multi-asset funds, he's talking about equity, debt and gold, outperform pure play funds, and can we consider investing in them for long-term goals over mid and small cap funds? So Uday, what would really be your answer and advice to him? He's talking about pure play equity funds versus the kind of multi-asset kind of funds as well.
So there are 2 possible answers to this, right? So one is basically looking at it just mathematically, numerically. And if you look at these numbers in the past, and if you are really, when you say, somebody says long-term investor, I'm saying that, hey, between a 5 to 10 years sort of at least a minimum 5 to 10 year kind of an investment horizon. So we should just sort of make sure that we have sort of made that clear when we say long-term, and it's not just 12 months after which it becomes long-term capital gains. No, it is at least 5 to 10 years of investment horizon. Now, if you just look at from a data perspective of what has happened is that, and a kind of look at mathematically, financially, you will see that over long periods of time, any such multi-asset portfolios will possibly get defeated by a pure equity portfolio, right? Because equity is a high earning asset class over long periods of time, and to that extent it can yield better returns. Now what happens though is that holding on to a pure equity portfolio behaviorally can be extremely challenging. You could start with 100, it could go down to 70, it could go to 80, it could go back up to 110 before it goes down again, and then you sort of, to really stick around for a 10-year, 15-year period requires a lot of patience. And I like to quote Warren Buffett, who says that it is not the economy that will do in the investors, it will be the investors themselves, which essentially says that we do not have the patience at times to stay with an asset class long enough, and when we see downturns in a specific asset class, we sort of give up. So that way I feel a multi-asset portfolio behaviorally is much suited for most of the investors, because what happens there is that, let's say if a particular asset class equity is not doing well, you have fixed income and gold possibly doing well. When fixed income is doing okay, but you have equity doing really well. So overall what happens is that you don't see as much volatility as you see in a single equity asset class, and that is what is more important at times, right? Because for you to see the 10-year result, you have to have the ability to see those short-term 6 months, 1 year shocks as well. But if you can't last those 6 months, 1 year shocks, then you're better off with a multi-asset portfolio rather than a pure equity portfolio. So I think behaviorally, for most people, I would say a multi-asset portfolio would do better. But when you have very clearly assigned goals and you think that no, I can really go through with this in patience, then a pure equity portfolio will be better. And for people who are doing this for the first time and don't really know how patient or how strong they will be, I think what makes sense is that put some amount of money in both the portfolios and see how it goes, how you react as these portfolios change in value. You will understand yourself better and hopefully over periods of time become better investor.
Right. Well, Ravi, hope that answers your question. Historically, of course, like Uday was saying, pure equity funds tends to outperform multi-asset and multi-cap kind of funds. But when you diversify, it also takes away from the kind of returns that pure equity funds can make you. Well, moving on, Dinesh Sheth sends us again an email. He says, what kind of mutual fund investments would you suggest for pension planning? He's 39 years and an average risk taker. Uday, as far as retirement planning is concerned, again, this is something where we get a lot of queries from people trying to understand how to go about planning their retirement. In this particular case, what would be your advice for him?
So essentially, I mean, as we keep talking about it, planning about retirement is basically planning about maybe multiple phases. Right now, Dinesh is currently working, 39-year-old. So let's say if he has that usual retirement age of 60, then he has basically 21 years until he actually retires. So that's like the phase one, where we are talking about for the next 21 years, he's going to save, create a corpus and a kitty for himself to last during his retirement. Post 60, then possibly he will have maybe another, and given how medical advancements are happening, maybe another 20, 21 years, 25 years of living in retirement, of which maybe sometime he's still consulting, working, and then possibly completely retired as such. So we are talking about multiple phases here. And obviously we don't want to think about all the phases here. What is relevant right now for Dinesh is basically accumulating that value for retirement. And to know what that right value is, he's already told us he's at an average risk taker, and at times we need to be very clear what that average risk taker means. But let's say he's a moderate risk taker. What is more important is just to understand is that what is this requirement of corpus, and for that you need to understand what your monthly expenses are today, what are they likely to be in the coming future, and then see that, hey, okay, if my monthly expenses are X, and if I were to retire after 21 years, how much would I need on a monthly basis? So let me just take an example, and I've shared some data with you. So let's say today his monthly expenses are 50,000 rupees a month, and we expect an inflation rate of around 6%. By the time he retires at the age of 60, 21 years from now, he will need monthly roughly around 1,70,000 rupees to sustain that same 50,000 rupees of expense per month. So which means that obviously inflation will go up and make sure that your monthly expenses sort of keep going up as we sort of move forward. Now to make sure that he reaches and receives this 1,70,000 rupees per month for the next 20-25 years in his retirement, he will have to save at least 50,000 rupees a month for the next 21 years, earning him 10% to create that corpus of around 4.5 crores that he will require for retirement. So when he's planning about retirement, he has to think about his regular expenses, how much money can he save right now, what kind of returns does he expect to take. Now, a few other things that I would like to highlight is that this is an exercise which is 21 years forward, right? So nobody really knows what is going to happen 21 years from now. So this is something that you need to keep repeating every 2 year, 3 year to see that, hey, am I on the right course of action? The other important thing that he needs to remember is that you have a lot of time. You have almost 2 decades of investments in front of you. So obviously you should be, unless you have a lot of money, you should be taking risk with this money, investing it in asset classes that will earn income higher than inflation. So equity, possibly putting in some money in land, creating a rental asset. So these are the kind of assets that you should be building your money in and sort of keep growing that portfolio as you sort of move forward.
Absolutely. Well, Dinesh, that's your answer. You've got 20 years ahead of you to invest for your retirement. So keep it simple and invest in assets where you can maximize your returns. On that note, let's slip into a quick break. We'll continue on the other side, but meanwhile, do keep your queries coming in. You can get in touch with us on Twitter, on Facebook, or you can even call us. All the details up on your screens, and we'll get all your queries answered by our personal finance experts on The Money Show. Welcome back. You're watching The Money Show, and we have with us Uday Dhoot of OiPaisa.com to answer all of your financial queries. Uday, before we get to our next set of queries, another very important, since we were talking about investment checklist just a while back, another very important checklist to have is as far as your health insurance is concerned, because again, that tends to be a little confusing for people as to when it comes to how much health insurance do I need, whether my employer's health insurance is enough, do I need to opt for a separate cover as well. So take us through what are the important elements there that one should keep in mind while opting for health insurance.
So, first of all, I think we can go ad nauseum about this, but I think health insurance is one of the most important financial products that pretty much every single family requires, because health expenses are going up very quickly, and as we know, in India we do not have any sort of government support to support us during such times. So it is very important that we make sure that we are providing for ourselves during such times. Now, there are essentially people who are working, and they are largely covered by their employers. But here, one important thing to highlight is that you really need to think whether that is sufficient for you. So, what kind of things that you should be thinking about when you're buying a health insurance policy? What should be your checklist? Is that first of all, what is the sufficient sum assured that is required by you, right? So, for that, the things that you should be considering is that what is your current age? How healthy are you, what is your family health background, and how much premium can you afford. And your company insurance may not always be sufficient. So people living in metros who at least have a 5 odd lakh rupees, 3 to 5 lakh odd cover, and depending on how your lifestyle expenses are, you might want to look at it further. As we already know that today you can buy health insurance up to almost 1 CR. So just see how much premium can you afford, and then accordingly pick that right health insurance amount for you. More importantly, keep looking at it every 3 years, 2 years to see that, hey, do I really need to now increase this health insurance cover, or this sufficient? Has anything changed? So this is very important to keep increasing those covers at least every 2 or 3 years, so that you keep up with inflation as your age progresses, and so on and so forth. The other thing, typically when you're looking at premium affordability, is the kind of add-on benefits that you have on your health insurance policy. Many times a question that we keep getting asked is that, is my company cover sufficient, or why should I buy an insurance when I already have an insurance from my company? So here are multiple reasons why you may want to buy an insurance even if you have a company insurance. At times the insurance the company provides may not be sufficient. Other times you may suddenly end up thinking that, hey, I may want to take on my own, start my own business, or something of my own, and at that point in time what might happen is that you may not have health insurance, and whenever you take up a new policy, there might be waiting in periods during which you are not covered for specific illnesses. So it kind of makes it easy if you have something already. Yeah.
Right, Uday. So essentially, it's extremely crucial as far as your health insurance goes to have that kind of a checklist, and also opt for a different cover aside from what your employer is offering you. That can't be reiterated enough. But our next question comes in from Srinivasan, who says, I have 4 lakhs and I want to invest in mid-cap IT mutual funds and mid-cap pharma mutual funds. Which are the best mutual funds to invest in these 2 sectors? Uday, you know, I don't think there are any mid-cap IT and pharma funds as such, although there are funds that focus on these specific themes. Essentially, what he's talking about are sectoral funds. What would be your advice?
See, first of all, let me just tell one important thing as a sort of a disclaimer, is that sectoral funds are largely for investors who are seasoned investors, who have seen market cycles, who have seen sectoral cycles, who know when to get into a sector, when to get out of a sector, and to that extent, because they are far more volatile than your regular equity diversified funds. So I think most importantly, these are for seasoned investors. These are not for people who are passive investors, who are not active in the market, and so on and so forth. Now, coming to the specific question, whether there are any specific mid-cap focused IT and pharma funds, as per my knowledge, there are no specific mid-cap focused funds. Like you just said, there are IT funds and there are pharma funds. But I do see that within the pharma sector, SBI has some bent towards the mid-cap pharma companies along with some larger companies. So if you are interested, you can look at the SBI pharma fund there. Within the IT space, I don't see any of the IT funds having a large mid-cap exposure. They are all mostly invested in the larger companies. So pick your choice of the segment, maybe ICICI Technology Fund or an FT India Technology Fund. Any of these would do the job.
Right, so that's as far as the sectoral funds are concerned. Remember that only opt for them if you have some time to do some amount of active management, and also that they are more riskier than regular diversified equity funds. On that note, Uday, thank you so much for joining us. We're completely out of time, but from all of us here at The Money Show, thanks for watching and keep sending in your queries.